Good morning and welcome to today's edition of LiveSquawk's Market Talk. We're previewing the ECB rate decision due a little later on this afternoon, really. And I'll be joined by guest Eric Culp, our European editor, and Gunter Grimm, our portfolio manager, and general expert, really, on all things markets. And so before we get into that, just a quick disclaimer, as always, with this. The content provided on this channel is for informational and educational purposes only. We're not licensed financial advisors, and none of the information shared should be considered as financial investment or trading advice. Please conduct your own research, consider your financial objectives, and consult a qualified financial professional before making any investment decisions. Investing and trading in financial markets carries risks, and past performance is not indicative of future results. We are not responsible for any losses or gains that may result from following the content on this channel. Okay, with that out of the way, let's take a look at today's ECB rate decision. Just a quick look at Eric Culp's piece. We've got a piece out there. It's for public viewing anyway, and on our website at livesquawk.com. ECB poised for next 25 basis point rate cut as EU-US trade feud ramps up. For those who don't know what's been going on, again, the last few days now, the US president has put pressure on Europe, really, over trade duties, and it's been reciprocated by some threats from the Eurozone side as well. Just to give you some of the subtitles here: downward revisions likely for inflation and growth forecasts. Traders expect at least one more cut this year with sub-neutral rates. And the question mark is sub-neutral rates. Are they coming? That's something we can discuss. If anyone who wants to listen in live, you can take a subscription out of free trial for LiveSquawk. The decision itself is due today at 12:15 GMT. That's 14:15 Central European time. That will be then succeeded by a press conference that comes in about half hour later at 12:45 GMT and 14:15 CET. So we're widely expecting the European Central Bank then to lower its key interest rates today, day after the US piled more tariffs on the world's exporters, as Eric writes. So I'll bring in the guys at this point. Eric, if you want to just frame really what we're looking for at the moment from today's decision.
Yeah, sure. I think, inflation in the Eurozone. Well, first, hi, everybody. Inflation in the Eurozone fell below the ECB midterm target of 2%. It dropped to 1.9%, at least according to a preliminary report on the May data. I mean, that basically all but guarantees a cut today. 25 points is probably what's going to happen, 25 basis points. There's not much talk of a jumbo 50 basis point cut at the moment. I don't think the ECB wants to rock the market at all. They've been talking about this cut. The members, the officials there have been talking about cutting for, since the last cut in April. And I don't see any reason why they wouldn't. Trump has made it easier. U.S. President Donald Trump has made it easier on them by jacking up steel and aluminum export or import fees to the U.S. to 50% from 25%. So, there's some concerns about growth here, and with inflation on the wane, why wouldn't they cut again? Especially since, data dependency is now the watchword or the watch phrase at ECB HQ in Frankfurt.
Yeah, good point. Like you say, he's given them a free pass on this one, I guess. Gunter, what are your your preliminary views on what we're looking for from today? And is this an important pivotal meeting, or we're just going to have to see a few more of these along the way while this tariff war situation continues?
Yeah, I absolutely agree with Eric that hello, first of all, as well. Thank you for having me. So I agree with Eric's view. 25 more or less baked in the cake, has been for a while. Although the ECB says it's still data dependent, looking forward or having more a forward-looking view on the relevant data, I think the easing bias will remain and maybe even exceed what's currently priced into the curve. And why I think that is as follows. We have arguably weak growth, and also now wages seem to fall according to the ECB's wage tracker. And then more importantly, even we have a stronger euro and falling energy prices. And if I incorporate my view on when it comes to the euro-dollar exchange rate and energy prices, I can see the risk that these trends will persist. So higher euro-dollar, so stronger euro, and even more falling oil prices, given what's going on with OPEC. It looks like the Saudis are very determined to increase output even further. I don't know what kind of deal they have with the Americans, if it's a precursor to maybe an escalation in the Iran conflict. But so I think these trends should continue and therefore lead to falling inflation from here. And as I live here, just as an anecdote, I live here in Switzerland. We are talking about negative interest rates soon, I guess. And the big fear here is that the ECB follows the SNB's path and also lowers rates even further, maybe even close to zero. That would be a bit of a nightmare for the currency here, but that's another topic. Hello?
Yeah, on that topic, I think that interest rates here in the Eurozone, I'm based in Frankfurt, they probably, there's some conjecture that they're going to could go as low as 150 at least. Morgan Stanley's saying that. They put out a report recently about their mid-year outlook, and they don't see growth above 1% in the Eurozone through 2026. At the same time, inflation's on the wane, so why not go to 150? I mean, what do you think?
Yeah, definitely. So if I look at the curve, as that's 2 days ago, Citibank Stir run, the yields are about to bottom, are expected to bottom in February 2026 at around 1.6%. And yeah, I think that's not only likely, but my risk scenario would be that we end up even lower than 1.5, maybe 1.25 or 1 even, if these trends persist. I would assume the dollar again to weaken. If that changes for some reason, or if oil prices rise, if I'm wrong on these forecasts, then we have to reassess the situation. But at the moment, I think the risk for the rate path is to the downside.
Just to add to that, there's a piece from the ECB, from JP Morgan's Greg Fazezi, that says they say ECB is very likely to cut rates by 25 basis points again this week, taking the deposit to 2%. Hawkish Governing Council members had originally contemplated a pause in April, but shelved after that Liberation Day. Arguments for a pause are likely to resurface this week, but a large majority is likely to support another cut. The ECB will also likely stick with its meeting by meeting and data-dependent approach, which suggests no clear signal for July. While recent commentary has become more favourable of a July pause, event risk is high ahead of that meeting, and the final cut to 1.75% still appears likely by September. We continue to see a July cut, but the timing of these depends on how US trade policy and data evolves ahead of the meeting. Now, admittedly, they wrote that before we got the latest from President Trump regarding the Eurozone. But as we know, it's such a fluid situation. Do you not think sending a message out now is a bit foolhardy? Should they not just continue with this meeting by meeting approach, because the situation is just so fluid? Eric, what are you hearing in terms of, is there much of a divide amongst members, or are you hearing anything along that regard?
I'm not really hearing anything. I think you're dead right about the fluidity of this situation. I would even call it chaotic. And I think I could probably get away with that, regardless of my political leanings. I think the real problem facing any decision maker on this rock at the moment is that they don't know what's next. The fact that the U.S. president in my home state of Pennsylvania talking to a crowd of steel workers saying, yeah, you know what, why don't we just jack up the tariffs on aluminum and steel? Let's just double it, to get a cheer? Is it legitimate trade policy? I don't know. They did cheer, it's a steel working state.
Mm.
I think the problem facing every member of the European Central Bank Governing Council right now is what is happening. You can't gauge what is happening. Consider the car industry at the moment. The slowdown in rare earth shipments is threatening to stop production. It has already stopped production among some component suppliers that feed the industry. Is that going to have a domino effect and hit all the other suppliers? Germany, Italy are highly reliant on the car industry, for example. And this is all caused by the tit for tat between China and the United States. I think they have no other choice but to wait and watch and react. They're purely in reaction mode right now, is what I think.
Well, and again, it's down to the policymakers. Gunther, do you agree with that? Do you have your own view on the situation and how officials, policymakers, are framing this at the moment?
Yeah, probably Eric is right that officially, so if you listen then to these official statements, they will convey a message of data dependent, and we'll have to see if we cut further. But I think the inherent bias is on the dovish side. You mentioned JP Morgan, they have a nice hawkish dovish tracker. And the majority of the ECB Governing Council, according to this measure, is on the dovish side. They use artificial intelligence to analyze their speeches, and the aggregate measure is also on the dovish territory. So, but I think we could hear every now and then a dovish commentary, but highlighting that the ECB is data dependent. But at the end of the day, they're dovish, and I think they're likely to cut even more.
I'm 100% with you on that, Gunther. I think they're in a hawk flying around Frankfurt right now. There can't be the amount of uncertainty in the market among business leaders. Even I think it's unprecedented.
Yeah,
and there's no way but down right now.
Agreed.
No, understood. So we then turn to maybe the forecast here, the projections, staff projections. JP Morgan says on growth, the forecast is likely to show a sharper second half of 2025 slowdown, followed by a modestly above trend recovery next year, leaving annual rate averages looking quite benign. On inflation, they have core inflation looks stickier than expected in the spring, with second quarter 25 perhaps 0.3 percentage points above the March projection of 2.2% on year average. This is probably not just due to Easter. However, wages may be slowing more quickly than expected, while energy and currency effects are giving disinflationary impulses, which keeps the disinflation narrative firmly on track. Is there a danger, Gunther? I'll come to you first for this, and based on the growth projections you see here, which is, they say benign, and so maybe stagflationary, of us overlooking the core issues that affect Europe because you've got this bigger battle across the Atlantic at the moment with Trump, or do they remain focused? How hard is it to remain focused, I think, on their mandate over what they're seeing and what they're hearing from their own politicians and from the US at the moment?
No, I think you're right. The uncertainty is super high, and the end result could be a very negative one. Let's say if the US and Europe don't agree on a trade agreement which serves both sides, then you have a very negative scenario, or even more negative scenario than as it is now for the Eurozone. And how will the ECB react? Let's say you have more tariffs, maybe you see an inflationary impact in the short term. I think they will clearly look through this one-off jump, especially if the euro continues to strengthen, and will more look at their other mandate, unofficial mandate, which is to support the economy, and therefore will on the side of further easing.
Okay.
Personally, I'm quite skeptical on these trade agreements. I think it could all end up in tears, but that's my personal bias. So would not be surprised to see.
Well, let's explore that a little bit. Well, I mean, if you want to expand on that a little bit, you're quite. We've had these discussions before on this show before, and so I'd just like to get a little bit more insight into what your more skeptical view is on all this.
Yeah, sure. So first of all, US-China, I think the Chinese will play hardball, and the way Trump has reacted, first jacking up tariffs to, what was it, 145% or so, and then retreating, selling it as a gift to China. I think he's got it the wrong side around. So I think the Chinese had the better cards, and they were just sitting and waiting there to see how the US economy would suffer if they don't get these Chinese goods. And so that makes me skeptical that there will be a great deal between China and the US.
Right.
And things could happen between the Eurozone. I think the US still has a minimum tariff of 10% in mind because they need the revenue for the big, beautiful tax bill. And I'm not sure the Europeans will agree to that. And they have the other big card, which is the service sector card, i.e. taxing the Max 7 here in Europe, because the US runs a decent service trade surplus with the Eurozone. And if the Europeans start to tax that surplus, then it could become a bit tricky and volatile.
Interesting. Right. So we've got the ECB rate decision. We're all pretty happy that we're looking at a 25 basis point move today, with potentially some signalling that they're open to further cuts down the line, but will stay non-committal to a degree at the moment. We also have non-farm payroll tomorrow. The US is facing its own issues at the moment, and employment is looking to come in on the softer side as well, from the latest sort of survey evidence. If I get the chart up that we have. So yes, the bank survey, if it comes up, that's it. Let me see that. So yeah, 126,000 is the expectation for today, the latest survey. Expecting, that's the median forecast, 4.2% unemployment rate and a 0.3% average hourly earnings on the month, and 3.7 on the year over year. Top end of the range is we're looking around 170, and then we're looking at around 105 for the low end of the range. From Gunther, this is more for you on US policy itself and the US economy itself. Are we looking at their own problems? Was Trump right to have another go at Powell about he's being behind the curve? He actually used the ECB and other central banks as a standard bearer, saying, "Look, they've cut rates a number of times. Why aren't you?" Does he have a point? Or, are we seeing enough of a slowdown now in the US that Powell will have to start looking again at decreasing interest rates?
Yeah, I think if it wasn't for Trump's tariffs, they would be still on track to cut further, because if you look at the inflation rates, they're coming down, but the outlook is a bit murky because of these tariffs. That's why the Fed is basically saying at the moment we are on hold, we have to wait and see. But I think the underlying picture points towards a dovish outcome. So if you look at payrolls, I mean, it's a notorious difficult forecast to make. I think I've said that in the past. But if you look at the drivers of payroll growth, so weaker growth in general, I think I dismissed a bit these Atlanta Fed GDP tracker estimates of is it 4.6% now for this quarter?
Yeah.
Funny things going on there. But if I look at other indicators, so jobless claims, more importantly, continuing, and new jobless claims, that they are rising on a trend basis. The ISMs were weaker, manufacturing, and even more importantly, non-manufacturing. So the service sector, which makes up 70% of the economy, was very weak, disappointingly weak. below 50. The ADP, I usually dismiss that indicator because it's not very well correlated with the non-farm payroll estimate, but it was a big miss to the downside this time around.
It's lowest in over 2 years, I think.
Yeah, if you add it all up together, also with my view that tariffs are negative for growth because they're basically a tax, and if you are now a corporate, uncertainty is high, you probably don't invest and employ more people. If anything, you maybe cut costs. So yeah, the outlook for me is negative, and therefore I would not be surprised to see weaker payroll numbers going forward, and therefore the Fed then finally giving in and cutting. Even very rapidly, if you see a very negative payroll report, for example, like a negative number, which you can't exclude. Consensus is 100, standard error is around 100, so it could be a zero outcome on Friday.
Okay, brilliant. Well, I want to wrap it up there because, yeah, we're coming to the end of the show. It's a short one, and just to give you a flavour, our audience a flavour of what to expect today.
One quick note, if I may.
I'm sorry?
One quick note, if I may.
Yeah.
Sorry to interrupt you, but
no,
I think we're going to see some questions about Lagarde's tenure today. Also, there was a report about her possibly going to the World Economic Fund, something like that. And she hasn't come out publicly, as far as I know. The bank has made statements, but the World Economic Forum, that's it. The bank has made statements that she's going to see her tenure through 2027, but she hasn't said anything. So I know this is an aside and this is more like soap opera stuff, but I'm sure the journalists are going to be asking questions about that today.
Interesting. Well, listen, just making sure. It's going to be one of those in meetings where she likes to keep things relatively dull for everyone. So any sort of interesting questions on her tenure will be welcome, I guess. But so thank you, Eric, for adding that bit. So yeah, listen, just like to thank our guests again for today. Eric Culp, European editor at LiveSquawk News, and Gunter Grimm, portfolio manager. Thank you both for your insights today, and we'll push this out onto all our social media posts. And anyone who wants to listen in, again, 12:45 GMT today, the rate decision. Sorry, 12:15 the rate decision, 12:45 the press conference, all GMT times there. So listen in to livesquawk.com if you have a license, or else take out a trial. And we'll see you again. We'll do a recap for non-farm payroll tomorrow with some guests as well, hopefully. So we'll see you again soon. Thank you very much.
Thanks for having me.
Thanks for having me as well. Thanks for your service, Harry. Thanks. Appreciate it.